But over decades, you know, the fact that you have 5% of the population and 40% of the global GDP naturally started to revert back towards somewhat of a more even baseline. If you look back long enough, I mean, China and India used to be very large percentages of the world economy. They're reasserting themselves as being a very large percentage of the economy, and so things are kind of returning towards equilibrium, I would say, which is the equilibrium is somewhat multipolar. And so now that the United States is down to, depending on how you measure it, between 15 and 25% of global GDP, we're no longer the biggest commodity importer. That's China now. Over the past 20 years, China has replaced the U.S. as the biggest trading partner for most countries. So you look at most of African countries, most of Asian countries, Australia, even most of Europe, even parts of South America. The United States is no longer the biggest trading partner with most of those countries, and instead China is number one, and the United States is often number two. And so in that kind of world, the United States is still unrivaled in some areas. I mean, we have, the biggest, tech sector. We have the language network effect, the cultural network effect. We have, the most, obviously the strongest navy, so the ability to project power at longer distances than other countries. We have better rule of law than obviously China and many other countries, and basically deeper, more liquid capital markets. So we still have a number of strengths, but the world is obviously spreading out more. And, things get accelerated from time to time where trends start to roll over, but then something kicks into high gear. So we were already seeing that the world, that foreign central banks were really not acquiring treasuries anymore. But the events around Russia invading Ukraine and then us cutting off Russia kind of accelerated some of these actions where a number of these countries say, I'd like to diversify my reserves now. Maybe it's buying gold, maybe it's splitting reserves up, maybe it's buying commodity rights, whatever the case may be. I think we're seeing a more distributed reserve practice going forward. And then we're also seeing an acceleration in national blocks building alternative payment systems, so that should they get sanctioned, or even if they don't get sanctioned, they can route payments, without going through New York, right? That they can just route payments in a more decentralized world for payment structures. And so when you take those two things together, more decentralized payments and more decentralized reserve practices, I think in some ways we are seeing at least a trend change toward de-dollarization and a more multipolar world. Now, you don't really see that among the public, right? So, like if you look at, say, people in Argentina or Brazil or Nigeria, things like that, they want dollars, not yuan, on the street, right? It's not like the dollar's not really losing any power there. It's funny because, if you look at stable coins, over 99% of stable coins are dollars. Anyone can create a stable coin and issue another fiat currency, and they do exist. There's even stable coins that are backed by gold. But in practice, what everyone wants is dollars. So when Lebanon's currency collapses, they start using dollars and stable coins and things like that. Same thing in Argentina, same thing in Nigeria, to a less extreme extent. And so there's still obviously a very strong network effect for the dollar. So this is not something that goes away overnight. And, I disagree with Ray Dalio in some areas, but one of the charts that he does, he has a set of charts for his changing world order, thesis that he has. And one thing he does, he looks at reserve currencies over time in history, like the countries behind them. So the United States, Britain, Netherlands, whatever the case may be. And he maps out various metrics for those, for lack of a better word, empires. And, he looks at their education quality, their manufacturing quality, their economic size, their military power, their reserve currency status. And you see that some of them are leading indicators and some of them are lagging indicators. So things like education are leading. Other things like economic and military might are kind of coincident. So they're kind of at the center. And reserve currency status is actually lagging. So it comes up more slowly after those other things are built and dominant. And then even after those other things kind of hit their peak and start to roll over and are no longer as competitive with the rest of the world as they were before, reserve currencies, because of the network effects and because of the just entrenchment, they tend to hang around longer and be one of the last things to roll, hit their peak and then gradually roll over. And so I think we're seeing a similar thing with the United States, where many of the fundamentals are already a more multipolar world. The dollar is, probably past its absolute peak in terms of the percentage of total reserves and things like that. But it still has that existing network effect, and still therefore takes a long time to roll over as all these countries kind of try to figure out the frictions of dealing with, more currencies. I mean, we see, for example, India and Russia have had a multi-year plan to trade more. That was before the war, and then even during the war, India said, okay, we'll buy all the Russian crude then. And so, they also buy arms from them. And so you see a lot of Indian and Russian trade, but the challenge is that, at least in that arrangement, India's running a trade deficit with Russia because India's importing their commodities and their arms. And Russia doesn't know they don't want a ton of rupees. So there are challenges. The Indian market's not really deep and liquid enough and desirable enough for Russia to want to just plow all of their surpluses back into Indian assets. And so the question becomes, what do you settle in? What is the reserve asset that you're going to settle in? And so there are frictions with all these countries trying to use something other than the dollar. So this is like a long-term thing, in my opinion. I think it's attractive as a slice of a portfolio. I mean, I own gold. I kind of look at it as a big cup and handle pattern, for lack of a better way of describing it. That'd be my base case expectation. Obviously, I can't predict the future, but I do think if you look at central bank gold reserves, they were declining from the 70s until around 2009. That's when they hit their low point, and then ever since the global financial crisis, you saw like a V-shaped trend line where central banks started accumulating again. So it went down from something like, say 37,000 tons down to 29 to 30,000 tons. And they've kind of built back up to that prior 37,000 ton level. I don't have the exact numbers in front of me. And that's, in recent quarters, that's continuing. They're kind of, that's kind of the one money that they can hold, that if they self-custody it, it's got no counterparty risk. It's kind of inbuilt inflation protected because supply only grows by something like 1.5% per year, and so they have that degree of protection. And so I do think that gold reserves and gold price in general, I think has a constructive outlook in a more de-dollarized world and a more inflationary world on average. I think large investors are generally under exposed to that. Retail investors have kind of been big on gold coins and things like that, but you don't really see large pools of capital that interested in it. And so if they ever do kind of leg into it, there's a lot of upside potential. So I do think that gold's pretty attractive, and I agree with you that it's mostly monetary premium. It does have industrial uses, but gold is mostly money. Silver's kind of in that hybrid scenario. And so, for example, I do look at things like the gold and copper ratio. It's kind of like almost magic when you compare the gold and the copper ratio to Purchasing Managers Index. They're kind of ebbing and flowing at the same time. And that's because really, gold trades more like a safe haven and copper trades more like obviously an industrial metal. And so you generally see those types of characteristics. But I do think that gold is one of the assets that is probably going to do well between now and 5-10 years from now, compared at least on a risk-adjusted basis compared to many other types of assets.